Blackstone's John Gray is positioning for the future. Our equity and debt strategies operate in multi-trillion-dollar markets that generate enormous flow of IG debt, often where Blackstone is the leading player, including data centers, energy infrastructure and real estate. Michael Zawadzki of Blackstone joins us now for more. Michael, good morning. It's good to see you.
Thanks for having me. Great to be here.
Tech is in the news in a big way this morning. We're hearing from some companies that they are constrained by capacity. That means we're going to see a lot more spending through next year and maybe even beyond. Can you walk us through how you and the team are positioned to succeed in this world and how big this opportunity might be?
Well, I think this opportunity set is massive, right? And one of the great things about working at Blackstone is we're long-term thematic investors, and we try to spot these mega trends. And clearly, AI, energy transition, and infrastructure is one of those mega trends, and we play it on the private equity side in deals like QTS and our pending deal in AirTrunk in Asia on the data center side, but we're also doing it in credit. And the amazing thing is you have these long-term contracted assets that are fantastic for financing against, but also all the picks and shovels around it. A deal like CoreWeave, a data center infrastructure company, or Park Place, a services provider to that market, we can really take advantage of the entire ecosystem given the scale of our capital base.
What's the relationship going to be like with some of the major tech firms? What would that look like in years to come? Because clearly these companies don't want to become energy companies. They don't want to become real estate companies. What would that relationship look like?
Well, for us, it's becoming a financing counterparty against these long-term, high-quality assets with incredibly strong counterparties. And I think the ability to do that in scale and deliver what we call private investment-grade solutions to our clients, where they're getting excess spread for high-quality investment-grade assets, that is one of the strongest tailwinds we see in our business. Over the last 12 months, we've originated $38 billion of what we call private investment-grade assets with an A credit rating, but with 185 basis points of excess spread versus buying a liquid A-rated corporate bond.
Why go to the private market for this kind of financing?
Well, I think, Lisa, this is part of this long-term secular trend we see towards private credit. And what is driving it is this farm-to-table approach that we talk about, where we bring our investors right up to the borrowers. And in doing that, we can provide speed, certainty, customization, which is incredible for those borrowers, but it's also great for our investors because they can capture all the excess spread that comes with providing that specific and bespoke solution.
The reason why I ask is because typically I think of a Blackstone or an Apollo or an Ares as a company that looks for lower-rated deals and ends up earning outsized returns as a result of significant yield. The focus has been much more on investment grade. Why is the focus for a lot of these private debt and equity companies so much more on top-rated types of investment opportunities?
Well, I think there's three big reasons I see. Number one is the sheer size of the opportunity set. A lot of people talk about direct lending as the first inning within private credit. That's a $2 trillion market. This private investment grade opportunity set is $25 to $30 trillion. Second, it is so much earlier in its transition to private capital, maybe 1 or 2% penetration. And so you have a super long runway as we move towards this secular shift. And third, the mega themes that are driving it. We spoke about data centers. We spoke about energy transition. You have these incredible mega themes that are driving it. And that is what is leading to that solution set, which is super attractive for our clients who are looking at traditional fixed income markets that are at their all-time tight spreads post the GFC. And so the ability to capture excess spread without incremental credit risk in scale, that's what's creating the opportunity set.
I'm thinking back to the 70s when the high-yield bond market really financed a lot of the modern cellular infrastructure that popped up. I'm just wondering how much of this is entirely funded through companies and not at all connected to public financing. I mean, is this basically not predicated on any kind of public intervention, or is this often fueled by that type of activity?
Look, I think the healthiest capital markets come where you have both public and private, and this year, frankly, you've seen that, right? Even in a year where the public capital markets have been open, you've seen incredibly strong issuance. You've also seen private capital deployment. For Blackstone, we've had record year-to-date deployment in both our investment-grade and sub-investment-grade private capital businesses. And so this notion of a healthy capital markets requiring both public and private capital, that's one we fully subscribe to.
At a certain point, you have to wonder how much, and I noticed this with Blackstone, that credit was the leading and the biggest unit after really growing up as a private equity company. And it raises this question about a new model at a time where there are fewer mergers and acquisitions, whether it's for policy reasons or whether it's for transactions not necessarily being attractive enough to certain people. Is that the model going forward? The M&A is going to be suppressed, and there really isn't going to be the same role for the investment community that it used to have?
Well, I think when you look at what drove our earnings announcement on the credit side a couple of weeks ago, you had three important things. One, it always starts with performance, and we delivered nearly 17% gross returns across our private credit platform over the last 12 months, and our default rate stayed less than 50 basis points. Performance then drives deployment, to your question. We've had record deployment. We said in a release earlier this week that we've deployed nearly $40 billion deployed or committed in direct lending year to date. That is nearly double what we did in all of 2023. And then when you see strong performance, when you see strong deployment, that leads to strong flows. And that is why we're seeing our clients trust us with more capital increase by 20% year over year to about $432 billion across credit at Blackstone.
Michael, do you buy into this narrative, especially when it comes to things like M&A? People are waiting on the sidelines because they want clarity to next Tuesday's election.
Well, I think when you look at M&A, you have all the ingredients for an uptick as we look into 2025, right? You have a strong and resilient macroeconomy. You have cost of capital coming down. You have a lot of pent-up demand for slow exits over the last couple of years, and you have record private equity dry powder. And so all of that is fueling what I believe will be a strong uptick in activity into 2025. I think when we get past the election and some of that uncertainty goes away, hopefully that unlocks what we see.
You see that regardless of who wins?
I do, because the ingredients I mentioned around cost of capital, dry powder, pent-up demand, and a strong macro, fundamentally, I think those will be the drivers regardless of who wins next Tuesday.
It doesn't sound like financial conditions are tight. Why is the Fed reducing interest rates with that in mind?
Well, John, I think what the Fed is looking at is inflation data. And what we see in our proprietary data, we're fortunate to have access to so many portfolio companies in Blackstone, is that wage growth, while still healthy, is slowing. And importantly, shelter costs, which the Fed looks at on a lag, is coming down in our proprietary data. And so I think as inflation comes down to where the Fed is looking for it to go, I think that will give them air cover to take short rates down, and I expect to see that in the near term.